Yo, 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 what's up, everybody? It's Bueller, and today we're going to go through the Candlestick Handbook together. So I'm going to read through pretty much all of this, and we'll go over some other notes as they pop up in my head. But for the most part, I'm going to stick to the script of what's here, stick to what here is in this guide from Leeland. But the Candlestick Handbook has been very, very helpful, even for anybody in chat who might have already known about these patterns or might already use them while they trade, or just be aware of them at all. But it's just been helpful to kind of go over them again and really get the most in-depth breakdown you can get on this. I mean, there really isn't much more you can do beyond this. So I'm really excited to go through this with you guys. A lot of my favorite candlesticks are in this, and this is by one of my favorite traders, Leeland. He ended up making this handbook for everybody just to share for free, so that was pretty cool of him. But yeah, so you guys can read this first page on your own. It's just basically breaking down just some basics of what we're going to be reading. Here's the table of contents. I really like this as well because you can just kind of click to it. I won't click it because I don't want to, ruin it. But you can click on these if you're on the link, and you can just go straight to the page that you want to. You don't have to sit here and scroll through all the pages. You can go straight to it. So let's start with page 1. But the candlestick basics. We have candlesticks provide, and I know what you guys are gonna say before I start this. Why is he even reading this page? We can read this on our own. We understand what candlesticks are. But when you're looking at candlestick patterns, you can start to jumble up stuff. There's plenty of times where I've seen people, see a bullish kicker and be like, oh, this is a gap up. But there's many times where people will be like, "Oh, well, I know all this. I don't need to re-go over this. This is so basic. This is level 1 stuff." And yes, it is. But at the same time, when you're looking at candlestick patterns, you can definitely jumble up what the patterns look like. There's many times where I've seen people in chat, be like, "Oh, that's a gap up, or that's a dark cloud cover, or that's a star, right, or that's a hammer, right?" And I'm always having to correct them or tell them the basics or the rules behind each candlestick pattern. And it's not their fault. There's just a lot of candlestick patterns. And this is really important because if as long as you understand, okay, this is the open, this is the low, this is the close, this is the high, and then this is going down. This is the high of that candle, but it went down. If you understand the direction of this, it's very helpful when looking at multiple candlestick patterns or just a chart that has a lot of candlesticks that you're looking at. But let's get into this. Candlesticks provide a visually intuitive way to understand price action. Each candlestick represents a specific period of time specified by the user's selection, such as the 1-day, the hourly, the 5-minute, etc. Candlesticks come in many different forms, but they all have 4 stats in common: an open, a high, a low, and a closing price. They all have these. And you guys are very aware of this because we use these exact levels on all kinds of different things, not just for candlesticks, but also on the different days using the daily. But the thick body of the candlestick shows the difference between the open price and the close price. If the body is colored green, it means the closing price was higher than the opening price. A red body means the closing price was lower than the opening. Thin lines extending above and below the body, known as wicks, indicate the high and low prices reached during that time period. Candlesticks can help identify possible trend reversals, support and resistance levels, and areas of decision. Now that we understand what a candlestick is and how it forms, in the next section we will start learning about some of these powerful candlestick patterns. And of course, if you guys have any favorites, mark them off as we go along. Dojis. We're going to start with dojis because I feel like these are, honestly, I'm really happy he put this first because these are like the perfect starting point for understanding candlestick patterns. But this candlestick has a longer and an upper and a lower shadow, which are basically just the wicks, with the doji in the middle of the candle's trading range, clearly reflecting the indecision of traders. When you see long-legged dojis, it is a sign for you to wait for the next candle as a confirmation of the direction. And this is a great picture he has here. As you can see in the example to the right, the 2 highlighted candles are nearly identical, this one and this one here. But the following candle, after the first long-legged doji, gapped down with continuation. So it got a lower open, breaking previous day low, and it went down lower. Again, kind of adding on to the bearish confirmation there after that lower open, which is good. However, after the second long-legged doji, price did the opposite and gapped up into a reversal. So you can see here, we ended up getting a bullish kicker, ended up having a very positive day, ends up even moving past this little gap here, ends up going past this day, almost makes it to the high of that candle. This perfectly illustrates the indecisive nature of the long-legged doji, and you'll see plenty of these. Basically, anytime you see long wicks, long legs like we talk about, and small bodies, this is a big, big, big thing that a lot of you guys will see very, very often. So get used to seeing it, and just remember, whatever comes next is really what you're going with this information. Not just, oh, what level is it against, but also using what is that next candle telling you, because this is really something that you got to pair alongside another candlestick. And here's the continuation of dojis. These are really good examples here because this goes over not just a bullish example of a bullish doji, but also the bearish doji. You can see here we have the dragonfly and the gravestone. Either way, you can call these, bullish dojis, bearish dojis, like I do in chat. You'll always see me call it that just because it's very quick to say that way. And it's kind of sometimes hard to remember the names, but you can see though, the dragonfly doji is very rare, but powerful reversal type of candle. It has a very small or non-existent body with a long lower wick. The open, high, and close prices are all at the same level. This candle suggests that sellers drove the price down during the period, but buyers were strong enough to push it back up to the opening price by the close. It's often interpreted as a potential bullish reversal signal, especially if it forms at the bottom of a downtrend. And then the gravestone doji. And just like the dragonfly, the gravestone doji is also a rare but powerful reversal type candle. It has a very small or non-existent body, a long upper wick, and the open, low, and close prices are all at the either close or near the exact same level. So sometimes it'll be a very, very, very tiny, almost non-existent body, or you'll see a literal non-existent body where it's just a line. You'll see that occasionally. This candle indicates that buyers drove the price up during that period, but sellers ultimately pushed it at the way back down to the opening price by the close. It's often interpreted as a bearish reversal signal, especially if it forms at the top of an uptrend. Again, I like how he adds that too, because again, patterns with positioning. We're not just looking for, don't just look for a pattern and be like, all right, I'm taking puts. No, you got to also find this when it's at the top of an uptrend, or if it's just coming off of good resistance. Then that will, of course, give it a lot more probability of going the direction you're intending. Well, let me get a swig of water. Hammer. And this is one of my favorite candlesticks. If you don't know about this one and you've been around me for a while, definitely join in on the streams more. But the hammer, a bullish candlestick pattern found at the bottom of a downtrend. The hammer candle has a long lower wick and a small candle body with the body at or very near the high of the candle. And I can't say this about every candlestick pattern, but this is one of the ones that literally looks just like the name. It's a hammer. Picture a hammer in real life, or even like one of those Mario style hammers like in a video game. You have the under hammer part, the handle, and then of course you have the steel where the hammer actually sits. So just kind of cool to think about. But the long bottom wick, especially when found at support or at the bottom of a downtrend, signifies sellers have been exhausted because of course they've had to push down, and then buyers were able to take it back up and not just close positive like we see on the bullish doji here where they push up and just barely get back up there again. This actually gives them a lot higher of a close. They have more of a meteor close there. So that's what I like about it the most. Did I miss any part? Signified sellers have been exhausted and buyers have shown presence to stop prices from moving lower. Kind of what we talked about. Side note, the dragonfly doji from the previous section is also a hammer. There you go. I was going to say, they're basically all the same thing. You're basically just seeing different strengths. I would say this is very rare, and it's very rare because it's not often you see us only take that much control back. Sometimes you're going to see more. So you're going to see a lot more hammers than you will those dojis, and vice versa. You're probably going to see more piercing lines, more soldier candles, just because there's more control being taken. It's an aggressive retake. The 5-minute chart example above perfectly illustrates the power of the hammer candle. On this day, the stock had strong selling pressure at the open. You can see we opened here, dumped over the course of multiple candles here. On this day, the stock had strong selling pressure at the open, the vertical dashed line, but as price reached the previous day's low, sellers lost control as buyer demand increased significantly. So they reached down to previous day low, built a doji, very indecisive candle, and then gave a bullish hammer, signaling, hey, we're probably going to reverse back up. Now, this isn't saying we're going back to the top of the chart. We don't know that it's going to hit previous day high, but whatever levels do we have here? So you have previous day low, you got the previous day close, previous day high. Of course, there's probably a previous day control point somewhere between here. But there's always good levels to aim for, even when you do have your levels pretty far away. But very good positioning here. Indecisive candle, so a good example again from our doji example above. And then followed up by a hammer, kind of confirming, okay, not just that doji, but now we have a bullish hammer signaling, let's go up. Let's move on to the next before I keep saying the same thing. So the hammer. The SPY daily time frame chart example above is another example of the strength of the hammer candle. I love that he goes so in depth on this candle because this really is my favorite. After a golden pocket retracement, buyer stepped in on January 17th, 2024 and formed the hammer at a price around 472, followed by a non-stop rally to 500. So if you take it from the rally from here to here, this fib, he gets this halfway point in this golden pocket area. They end up slowing down, gapping down, Doji, into a hammer, and they end up holding at a bullish area of this rally. So very, very cool midterm reversal here. Very good, strong bullish reversal using a bullish candlestick pattern, the hammer. Important note, for additional confidence, look for hammers to appear at the bottom of a downtrend that is secondary to a larger primary uptrend. So you're not always looking for the first test. You're not always looking to take every single hammer you see. You really want to wait till you get that higher low. The reason this should... Oh, my bad. I skipped a part. Price was already in a strong uptrend. The downtrend retracement to the golden pocket was a secondary trend to the uptrend. I like that he put that too. And we have a very popular video on my channel that covers primary, secondary, and tertiary trends. If you guys aren't familiar with this, vocab, but definitely check that out if you haven't. The reason this should add confidence in the hammer is because you are stacking confirmations in your favor. We are in an uptrend, and then a bullish candlestick pops up at a probability of retracement. This is the very same logic that can be applied to every candlestick pattern that is covered in this handbook. So it's not just this candlestick, it's not just for uptrends. You can use this for bearish candlestick to the downside. You can use this for any candlestick pattern that pops up here, because some people are going to be like, well, isn't this also a morning star? Yes, it is. Well, we haven't gotten to that part yet, so I don't want to ruin it for everybody, but you're always going to see that too after the fact. You're always going to see multiple candlestick patterns, many different ways you could have taken this trade, many different ways you could have taken other trades. So make sure you're backtesting as much as you can. And honestly, this is a really good example of just how to do that. All right, so what do we have here? The shooting star. So this is basically... Oh, and before we get into any more examples, I just want everyone to remember that pretty much every single candlestick you're going to see is going to have an exact opposite. And that's just true throughout pretty much every pattern we're looking through. Not just candlestick patterns too, chart patterns are the same way. But in this, we're talking about the handbook, we're focused on that. But just remember that. And that's a really easy way to remember different styles of candlesticks. Because I'm not going to lie, I have a horrible job at memorizing this many things. But it's really easy to remember when you remember that one fact. Wait, this is just the opposite of a hammer. And the same thing up here too when we're looking at the dojis. It's like, oh, this is just the opposite of that, and this is just the opposite of that. They're the exact same thing. They're just the opposite. One's for bears, one's for bulls. And it's going to be the same case for a lot of candlestick patterns. If you know what a piercing line is, the opposite's a dark cloud cover. Opposite of a hammer is a star. So it's just very cool to kind of know that just for in the future, so you don't have to remember them as much. Even if you don't remember the names, at least you know that there's an opposite to every single one. And you'll sometimes hear us call this the shooter, shooting star, stars. There's just all kind of loose names we throw out there. But this is a bearish candlestick pattern found at the top of an uptrend. The shooting star, aka shooter, candle has a long upper wick and a small candle body, with the body at or very near the low of the candle. The long upper wick, especially when found at resistance or at the top of an uptrend, signifies buyers have been exhausted and sellers have shown presence to stop prices from moving higher. Very nice example here with a common resistance here where buyers stopped here again. You can kind of see you got that doji here, the bearish doji right there. Another slowdown, another gap down. When they reapproach again, what do they reject with? A hammer. So very nice to take risk on. I bet if you draw a fib from here to here as well, I bet this is rejecting a halfway point or a golden pocket to some extent. Just kind of cool to think about, but really cool breakdown by Leeland there. In the example above, you can see price was trending up before establishing a clear resistance before one failed breakout that resulted in the shooting star candle. As you research this candle on your own, you will notice that the strongest shooters will often wick above the resistance, exactly like this example. So they're not always going to perfectly touch it like this or like this. It's not going to be perfect every time. It's going to want to go above because this signals that buyers are trying to take over. They have to fake out some people. So when they close back down again, they actually have liquidity and the momentum to really push the price down lower. So really cool example there. Side note, the same can be said about the hammer from the previous section. The strongest hammers often wick below a support. Very awesome side note there. Very cool, Leeland. Continuation of the shooting star. For additional confidence, look for shooting stars to appear at the top of an uptrend that is secondary to a larger primary downtrend, like the example above taken from the SPY Weekly during the 2022 decline. As we examine the two highlighted shooters, we can see that they are both rejecting a resistance to create lower highs. The reason this should add confidence in the shooter is because you are stacking confirmations. Bearish primary trend, bearish candlestick pattern at a high probability area of retracement. So not just finding, oh, we reversed from here, bearish engulfing, cool, brought us down, but of that drawdown, look where they came back and rejected again, another lower high. Draw down again, good bearish doji there again, almost an inside bar, draw down, pick back up. What did they reject again? They went over, they stopped back, another bearish hammer, another lower open here, and they crashed back down. So very cool example, not just seeing at the tops of the charts, but the lower highs. Again, same example here with the hammers. You're not just looking at the first one or the very first hammer here. You're not buying this hammer. You're looking for a true show of hands showing that, hey, they are holding that retracement. They are producing a bullish candlestick. It's really what you're looking for. Or in that example, bullish. In this example, bearish, of course. Engulfings, which I'm sure a lot of you guys are aware of these, and these are definitely not hard to forget just because they're so easy to spot. But this is when the next candle, basically what the word says, engulfs the previous candle, and it's just a very, very strong show of hands by one side. In this example, we're going over the bullish engulfing. I'm sure the next is the bearish. But the bullish engulfing is a very powerful 2-candle reversal pattern. It is the most powerful when found at a support and after a downtrend. And you're going to see that pretty much this repeated in every single example for the most part. Some of these will say 2, 3, but everything is going to say most powerful when found at support or after a downtrend. And when we're looking at bearish candlesticks, you're going to see it says most powerful when found at a resistance or an uptrend. And again, at the top of an uptrend. And that's because it's given the best positional, it's given the best positioning for what it can do. So if you're getting a bearish candlestick pattern at let's say all-time high was hit, and then we come back down, and then we reject all-time highs, and then that candle produces lower high. That's a lot higher probability than just randomly shorting all-time high, because again, you're given a good probability away from that move, and a good candlestick pattern shows up. But I'm rambling now. It begins with candle 1 closing red, followed with a candle 2 gapping down. So again here, remember the candle closing. We opened here, closed here, lower open the next day, higher close. So again, completely engulfing the meat of that day's price action. With candle 2 gapping down and opening below the previous candle's close, showing potential seller control at open. The gap down is met with extreme buyer presence, with the buyers taking price up and closing above the previous day's open, completely engulfing the previous day's candle body. Man, I need to quit just rambling. He's basically writing all this down. On 10/13/2022, SPY gapped down heavily after days and weeks of a heavy downtrend towards 350. After gapping down to 350, sellers were then met with extreme buyer presence, completely engulfing the previous candle, marking a potential change in the trend. A very strong show of hands by buyers after it looked like we were just going to keep falling forever. Because again, you have a strong bearish downtrend here. Bearish kicker, very strong bearish candle, bearish kicker, and it's just a heavy lower high trend right here. But look, before it reverses back up, what it started with. It starts with this very strong show of hands by the buyers. Reset candle holds 50% of that candle. Hammer candle, gap up, reset. They end up holding most of the gap. Another bullish candle pops up. Next thing you know, we're in a different trend. We're in a completely different vibe of a market. We're not completely feeling like we're just falling off a cliff. So really cool breakdown there. To give you an idea of the power of this candle, the low of this specific bullish engulfing is the current 3-year low and sparked the beginning of a bullish rally from 350 to 500 in less than 2 years. Wow, that's crazy. And I will always remember this one. We know exactly where that is on the chart. Engulfings continued. So this is also kind of adding more and going a little bit more in depth, and that's what I really like about this handbook. But you can see here, combining patterns. I love this example because as you continue to learn about each of these candlestick patterns, you will constantly notice that they will stack like this, and you can use your pattern recognition to compound confidence in those patterns. So if you see multiple things pop up, like a bullish engulfing and a hammer and then a bullish kicker again or whatever, or maybe you just have 5 different candlestick patterns there, it's going to give you more confidence because you see that there's more buyer presence there, or in other scenarios, bearish presence. For example above, SPY begins in a downtrend, you can see it here, until reaching the 505 psychological level and prints a massive bullish engulfing on the 5-minute time frame. 30 minutes later, SPY retraces, so they push up, they come back down. SPY retraces to the golden pocket of the initial breakout move and prints a perfect bullish hammer. You can see it right here. It goes right below, tests the golden pocket, pulls back up, very nice higher close. While the engulfing alone is a very strong reversal signal, the higher low plus the hammer stacking on top of that adds confirmation to the trend reversal that began with the engulfing. So this wasn't just by itself anymore, where it started, it went lower, started lower and went lower, and then finished higher. It was also followed up by a higher low of this breakout's move before a slowdown occurred, and it actually held it with another bullish confirmation. So that's just cool. Again, combining patterns. I really like this page a lot. This is probably going to be one of the strongest trading concepts you end up using for majority of your trading, as long as you're using price action. Engulfing. So we have the opposite. You have bearish engulfing. So this is going to be the exact same thing. The bearish engulfing is a very powerful 2-candle reversal pattern. It is the most powerful when found at a resistance after an uptrend. It begins with candle 1 closing green, followed with candle 2 gapping up and opening above the previous candle's close, showing potential buyer control at open. The gap down is met with extreme seller presence, with sellers taking price down and closing below the previous day's open, completely engulfing the previous candle's body. And of course, we won't go more in depth. I just, kind of went over it a bunch, so we're just moving on. Because again, these are all basically the same thing, except some of them are opposites. So it's just, we don't have to go over them so many times. But the bullish kicker here. So this is again another one of my favorites. It's just so powerful. The bullish kicker is quite possibly the most powerful reversal pattern to exist. The 2-candle pattern starts with a red day followed by a gap up, with strong buyer presence closing the second candle green. This pattern is often associated with some sort of catalyst that causes the abrupt sentiment shift. Because again, guys, you might look at this and you might be like, oh, that's just a normal gap up. What's so strong about that? No, it's not. If you look at this correctly, you have the open of this red candle. It pushes down, it pushes down, it pushes down, it pushes down, it closes here. So the end of the day ends here, not up here. Then the next day opens up here. That means it just wiped out this entire candle's existence with just its open. That's insane. That's a very strong, and that's why it's, again, considered one of the most possible reversal patterns to exist. Because it may not be the thing that starts it, or, it might not be the thing that looks good, like it starts here and then it just rallies from here on. No, in some examples, it's going to fade off, hold half of the gap, then it's going to move again. But it's almost also always the initiator. I always call it that, the initiator. It's almost what initiates the price action sentiment change, like we said here. The extremely rapid change in sentiment from bearish day 1 to very bullish the next is what gives this pattern its strength. Any short sellers from the previous day are now trapped and will have to buy to close their positions, only increasing the buying pressure, again, making price go up even more because they have to close out their bearish positions. This bullish kicker occurred on NVIDIA on February 22nd, 2024, due to an earnings catalyst. At this time, NVIDIA is already in a strong uptrend, but began a small secondary downtrend heading into earnings. Like mentioned previously for the shooter, bullish kickers at the bottom of a downtrend that is secondary to a larger primary uptrend significantly increases confidence. Again, you should definitely be increasing confidence if it's not the first pattern you're seeing. If it's a higher low, it's definitely going to add a little more probability to it and should definitely make you a little bit more confident in what you're looking at. So page 12, damn, we're flying through this. Hold on, let me get another sip of water. Bearish kicker, sorry, I almost said bullish again. The bearish kicker is quite possibly the most powerful reversal pattern to exist. The 2-candle pattern starts with a green day followed by a gap down. So kind of like another example, except opposite. We open here and we closed all the way up here. Price rallied and closed right here. But the next day, we didn't just open inside of this day or at the open or at the close or at the low. We opened entirely under that day. We took out the open and close. Very, very strong show of hands by the bears there. And again, same thing, but for the bears. This is making bulls close out their positions because they're trapped, and this causes more selling to happen, not only when they're closing their positions, but also afterwards when the positions are actually moving. So only increasing the selling pressure. Very important. And this is very big when you see us talk about this with our swing trading videos too. This example from SPY Daily on 8/19/2022 occurred after a 2-month 70-point rally. Buyers were hopeful that the 6-month downtrend was ending, only to get trapped in a bearish kicker. The selling that followed, as you can see, was relentless. And this is actually the big moves that happened. You see this move here? This is actually the move right here that is in this example. Right here. So that's that example. When we were on a crazy rally and we came back down for a pretty long time. It was pretty big candles pulling us back down. It was started with the bearish kicker. It wasn't just buyers getting tired. It started with the bearish kicker and really trapping everybody, kind of causing the next day to pretty much be red for the most part. I mean, it's almost inevitable that next day is red just because of that day, how they're starting things. And then, of course, you get some buying. They'd bring prices back up, make it look a little bit more attractive, and then just more selling. And from calculated areas, if you draw a fib from here, from here to here, you end up seeing that it does reject. If you end up drawing a fib from here to here, it ends up hitting a fib. If you end up drawing from here to here, it hits a fib. So they're not just rejecting random areas, and they're not just rejecting with random candles. There are clear bearish candles rejecting these areas. Sorry, I was going off on another end there. only to get trapped in a bearish kicker this following. So then again, nearly a month later, on 9/13/2022, aggressive dip buyers get obliterated in a second bearish kicker. You can see it here, followed by more relentless selling. From the first bearish kicker on this chart, the selling continued for nearly 40 trading days, resulting in a 19% drawdown on SPY. That is crazy. I like these stats he's bringing in here to kind of really show you the power behind some of these, in that it's not just an overnight thing. You know, sometimes you are taking overnight swings or overnight trades on these, but sometimes this is also just indications to you of what the market's trying to do. It's not always about catching a trade on each of these little, you know, pieces of info that you're getting. It can also just be for literally reading the market. So you might be able to think about it that way too. But the morning star, we're moving on now. The morning star is such an interesting candlestick pattern because it requires a total of 3 candles to form, but often has a single candle pattern baked into them, such as a hammer as candle number 2. It consists of 3 candles, the first one being a bearish candlestick, the second one can be bullish or bearish with a small body, and the third one is definitely going to be a bullish candle when you're looking at the morning star. Trading this pattern can be done in a variety of ways and can be extremely lucrative. Again, please, please bear with us here. Excuse me. Combining our prior knowledge of the strength of the hammer, we can enter at the close of day 2. So at the close of day 2, right here, in anticipation of bullish day 3 to complete the morning star. So basically, you're pretty much going for the fact that it is trying to hold a bullish retracement. Wait until day 3 to see the gap up for the confirmation of a morning star. Seeing that higher open is very good for you. Use candlestick patterns on the smaller and intraday time frames to find an optimal entry. Let's dive deeper into this. Okay. Morning star continuation. This is really cool. I like when he does this. So start by first examining the daily time frame. Imagine a day 2 has just closed and day 3 has not started yet, as this is when we will be planning a trade on day 3 of the morning star. We can all now easily recognize day 2 as a hammer, this one right here, but also that it's a hammer after retracing and holding the golden pocket Fibonacci level. So of this rally up, it's also holding a bullish area. So we're not just confident by the candle itself, it's also the positioning of the candlestick. On day 3, we can focus on intraday timeframes to see how price interacts with the previous day levels, previous day high, previous day close, etc., to not only find the most optimal entry, but to add confidence. You can see in the 5-minute chart above, price formed a one white soldier, which you can click this and see later on. It made a one white soldier pattern while reclaiming the previous day high and previous day close levels, which again is a very good sign because again, you're getting a bullish pattern at a bullish part of the chart. And you're already aware that you're looking for a hold of this area on the bigger time frames. You're aware of this a day before this has even happened. You know, you've slept in the morning of. You're thinking about this. So very cool breakdown there. And then evening star, and hopefully there's a continuation of this too. The evening star is a bearish candlestick pattern that's identical to the morning star except opposite. It's a very interesting pattern because it requires a total of 3 candles to form, but often has single candle patterns baked into them, such as a shooter as candle number 2. Again, the opposite of the bullish hammer, the bearish hammer popping up. It consists of 3 candles, the first one being a bullish candlestick, the second one can be bullish or bearish with a small body, and the third one is definitely going to be a bearish candle. Trading this pattern can be done in a variety of ways and can be extremely lucrative. Combining our prior knowledge of the strength of the shooter, we can enter at the close of day 2 in anticipation of bearish day 3 to complete the evening star. Wait until day 3 to see the gap down for the confirmation of an evening star. Use candlestick patterns on small/intraday timeframes to find an optimal entry, just like we explained on the previous example, except you're going to be going to the downside on this one. Again, every candlestick pattern that we're going to be going through has an opposite. So stars. Here's some more examples of the morning and the evening stars. So not just looking at them by themselves. You can see we're not just looking for any time this goes down and gaps up and then, or gaps down then gaps up. Why would this not be a morning star? I mean, it kind of is one, but it's not one because there's no positioning here. Whereas this one has a low and this is holding this as a higher low. This is what you want to see as a higher low. Same thing happens here. See how we're not just going for random trends. I can't even find a fake evening star here. There's not really one. Oh, okay, like right here. Actually, I guess that could be one. You kind of have an evening star here that kind of started things, but it's off of a good resistance. You see the same thing here, though. It's coming off of a good known resistance. It's not just randomly appearing here. It's appearing at a resistance. So make sure you have that. It's not just by itself. It has that level to go with it. Same thing for the morning star. And then piercing line. Finally, we're getting to more of my favorites. I love these. The piercing line is a bullish 2-day reversal pattern. The first day in a downtrend is a red day. The next day gaps down and opens at a new low. The gap down is met with buying pressure, then closes above the midpoint of the body of the first day. So basically what you're seeing here is a strong downtrend, or at least from this high. They end up giving us a lower open. They're holding a good level that we're aware of, whatever that may be. In this case, it's a good 50% of the range. But what's cool about this is they have a lower open, and where they close is interesting. So think about this as like I don't know, like tug of war. You know, they're pulling this way, they pulled really hard this way, and then they pulled back enough this way, right? And it's really cool because you can see of this move down, they actually closed back above the halfway point of this red day. So they've actually retaken a bullish amount of that red candle, even though at the beginning of the day they had a lower open and things were just looking like it was going to keep falling. So that's why we like it a lot too, is because it's a strong visual. It just looks like it's a good reversal, you know, just based off of control, you know, control of a candle to candle based on, you know, distancing. You know, if it's holding 50% of the golden pocket, it's bullish. If it's under it, it's bearish. You know, just off of simple reminder. But that's a very cool visual. This pattern is significant because the previous pattern's midpoint is seen as a point of control. Like again, I should have just waited. I should have just read that. The previous candle is a red day followed by a gap down. If sellers are able to maintain price under the midpoint, then you can say that the sellers are still in control. However, what we see instead with the piercing line is after the gap down on the second day, buyers are able to reclaim the midpoint and showing that they are potentially reclaiming control of the trend. Let's take a look at another example, starting with the daily time frame and then zooming in to an intraday time frame to see how price interacts to the midpoint. Again, to not just talk about it doing it, to actually look to see how to take trades on it. This way we can get better visual of how buyers and sellers literally fight over the 50% control point. And this is so, like I just said, so we can actually take real trades on this. So we're not just saying, oh, it took to 50%, it's a bullish candlestick. Okay, but did you zoom in? Did you try to take a trade on it? What are we doing here? So you can see we have a nice drawdown, we have a lower open, we have a pickup, and it ends up holding that, right? But what did they actually do down here? So here's that red day, here's that piercing line day. So they end up getting a lower open, like we know. They end up retaking the open, holding a higher low. They hit the 50%. They're still holding. They end up pushing over. And then ever since this candle, they seem to have just moved on and ended up holding that piercing line. Again, this is what gave us that candlestick. And then you can see the next day, they get a higher open, and it's over all of the struggle area. Everything we were struggling to hold above is now opening above. That's crazy. Very strong show of hands by bulls the very next day after a good show of hands the previous day right here. So now, again, just kind of following up with it. So it's very nice to see, not just on the bigger time frame, but also on the smaller time frame, so we can actually know how to trade it. Hold up. The dark cloud cover. The pattern starts with a green candle followed by a gap up. The gap up shows potential buyer strength for continuation at open. The gap up is met with selling pressure, with sellers closing the second candle red and below the first green candle's 50% control point, halfway between the open and close. The 50% control point is a very commonly used and powerful way of measuring who is more dominant in the market. And this is for any time frame. With sellers pushing below the 50% control point and holding below into the close, this shows you that sellers have potentially begun to overpower the buyers and the market. Like its bullish counterpart, the piercing line, this pattern is significant because the previous pattern's midpoint is seen as a point of control. The previous candle is a green day, followed by a gap up. If buyers are able to maintain price above the midpoint, then you can say that buyers are still in control. However, what we see instead with the dark cloud cover is after the gap up on the second day, sellers are able to reclaim the midpoint and showing that they potentially are reclaiming control of the trend. Very clear visual there. Let's take a look at another example, starting with the daily time frame and then zooming into an intraday time frame to see how price interacts to the midpoint. This way we can get a better visual of how buyers and sellers literally fight over the 50% control point. You can see above on the intraday time frame, halfway through the day, buyers tried holding above the midpoint with a hammer, but ultimately failed as sellers took control. So you can see, nice higher open, nice bullish kicker here. They end up holding that new high. Following that next day, they get the higher open. They even get a little bit of a push up. What follows after, though? A lower close. What did they close under? The previous day's midpoint. Why is that significant? Because this was the day that could have been sending them up. That could have been changing the trend to go up a lot more. What do? They close under the dominant part of that candlestick. They end up closing under. Next day is followed by a gap down. Is this always going to happen? No. But it's a very clear visual of what is going to most likely happen when put in the right spot of the chart. Previous green day, dark cloud cover, you can see where they pushed down. They had a higher open. They pushed, higher. Inside bar reversal right there, actually. They came down, hit the midpoint, pushed under it, rejected under it, reconfirming not just a break of it, but also a close under it, and then again, like I just said, a close under it. Next day gets the gap down, followed up move by the sellers, showing the strength of those sellers with that candlestick. One white soldier. So this is one that I feel like is going to throw a couple people in a loop. But I actually think you guys will get this down as long as you just, again, remember the rules of how candlesticks work. Open, close, right? So if we're looking at this candle, open, close, higher open, higher close. Just remembering the direction of them. Sorry, I had to drink more water. This reversal pattern starts with a red candle in a downtrend, followed by a gap up, with buyers maintaining control and closing above the red candle's open. This pattern is significant for a few reasons. The initial gap up indicates a strong and sudden change in sentiment from the previous candle. Price pushing higher throughout the day and closing above the previous day open is additional confirmation, combined with the gap up, that the trend may be reversing. Not every time, but it may be. So it's a good show of hands that at this potential low, we don't know, at this time, we don't know that this is the low of the chart. We don't know that these green candles are going to come after. But in this moment, we know that us getting a higher open and then a higher close is a very good sign, above a good 50% of that candle too, a very good portion of that candle, is a very good sign that buyers can potentially show up and try to work back towards whatever may be near. If it's this lower high, if it's this level here that we fell from, if it's this structure we broke down from, whatever it may be. And then the opposite, the one black crow. This reversal pattern starts with a green candle and an uptrend, followed by a gap down, with sellers maintaining control and closing below the green candle's open. This pattern is significant for a few reasons. The initial gap down indicates a strong and sudden change in sentiment from the previous candle. Price pushing lower throughout the day and closing below the previous day open is additional confirmation, combined with the gap up, that the trend may be reversing. Again, just kind of seeing the opposite. And then, of course, some of y'all's favorites, the inside bar. The inside bar's range is completely inside the previous candle's range, including the wicks. The wicks are 100% included in this candlestick pattern, so please mark those off. In other words, the candle's high is lower than the previous candle's high, and the candle's low is higher than the previous candle's low. So we're looking for them basically just to squeeze inside of the previous candle. This candlestick is especially powerful as it can be actionable for both continuation and reversal, and both sides use it. You need to wait for the following candle to confirm the direction, just like our dojis. So you have some special rules for some special candles. Notice in the example below, the highlighted candle is completely inside of the previous candle's range. You need to wait for the next candle to confirm the direction. You can use other factors to influence and confirm a directional bias. For example, below, 2 candles prior, we have a massive hammer candle. I'm sorry, you have one right here. I was looking at both. Really, there's a few there. The candle following the hammer, price retraces and holds the hammer's midpoint. So it is this one. So here we have this candle. Here's the inside bar. Here's our hammer here. You have a hammer here. So kind of initiating it, further initiating it. We're sitting inside of it. And then we get a higher open into a higher push. Price retraces and holds the hammer's midpoint. I really like that a lot that he put that there. Finally, the confirmation after the inside bar. A gap up and retest of previous day high. Right here. That is beautiful. Gap up and retest. So you get the gap up, and then they came back down. You can see that wick there, and they brought it back up. Very strong sign that buyers are definitely still present and most likely want to test recent highs. Very, very good example there. And then the opposite, the outside bar. Now, this one's a lot more intricate. Me and Leeland both have a video on the inside bar and outside bar in course number 2 on YouTube and the Discord chat, and it's just because it's so important and we see them everywhere all the time. But they're definitely very intricate and can be a little complex when looking at them. The candle's range it's just like the name. It's completely outside the previous candle's range. It's the opposite of the other one. Instead of inside, it's going to be outside on the right side candle. So in other words, the candle's high is higher than the previous candle's high, and the candle's low is lower than the previous candle's low. On smaller time frames, an outside bar is characterized by a megaphone pattern, or otherwise known as a broadening formation. You'll always hear these names thrown around the internet, and that's just what this is basically. We can look at the outside bar as a signal of rise in volatility, range expansion, or indecision. Usually the close of the outside bar as well as the overall trend will help provide context. So again, it's not like every single one of these need to be taken for trading. I like that he added that. It's also just for information getting. Do I want to be part of this market? Do I feel like touching this trade right now? And knowing that off of what you're getting, your context. So I like that he put that. There are 3 main methods for trading outside bars that I constantly watch for. This will be the longest section in this handbook, as this is the pattern I am personally most passionate about. Leeland loves this candlestick pattern. I can't get him off it. And for good reason too. I mean, it has really cool rules. It's not just for swing trades you can take, but what we like about it is it has so many cool, intricate rules for day trading, and it has set rules. If something happens, you stick to it for good or for bad. With the continuation method, we are aiming to take full advantage of the outside bar before it was even formed. To do this in a downtrend, we are looking for a short at a failed higher high and targeting a lower low. In an uptrend, we look for a long at a failed lower low and target a higher high. So we'll see this image here. And you guys have seen this plenty of times in chat before. Me and Leeland and plenty of the guys have shared it. But in the downtrend, shorting the higher high, expecting and targeting the lower low. So seeing this move up and then pulling it back down. You can see it here too, the broadening formation, getting that higher high, and then seeing how it broke structure right here under this high is where you want to take your trade. Uptrend, it's going to be the opposite, buying the lower low. So you're looking at getting this move, and then getting over that impulse high is a good secondary confirmation that you are trying to continue on. So a very good example here by Leeland. Expecting and targeting the higher high. So more continuation on the outside bar. In this example below, you can see we have the 1 minute on the left and the 20 minute on the right. We are looking to enter this trade on the 1 minute to take full advantage of the formation of the outside bar on the 20 minute. So this is where we get our information. This is where we're actually getting in and out of our trade. We are clearly in a strong uptrend given the initial explosive move. We can see that. We can see this 3-bar move. After seeing an initial low made, we wait. So we see a push, we see a hold to the right, we see a low get made, and then a hold over. When the lower low is made and fails to hold, we enter our long and target the higher high. So you can see they end up making a new low under this, and they end up closing back of it. This is also what you'll sometimes see Peoples or Leeland mention and call it the 90% entry. This is a pretty famous entry between some of the higher tier traders in our chat. I would say you get to this point when you've looked at candlesticks so much that you start to see this type of entry. It is a real type of entry, and it's a very effective, we call it the perfect entry because it is the perfect entry. I mean, to get that part of the chart is impossible on so many trades, but when you can break it down with the system like this, you can actually make it possible a lot more than not. It's not so impossible feeling. It's not so perfect. This is just a normal trade. But when you start getting into it, you're like, wow, this is insane because it is perfect. You're buying at the best part of the chart. You've already established a low. They've retaken that low. They're getting a really good move up into that high, and you can take good profits and even have your runners set because you've already taken a majority of profits and you can just let it go. And then the opposite, of course. In the example below, you can see we have the 1 minute on the left again, except on this time we have on the right the 15 minute. We are looking to enter this trade on the 1 minute to take full advantage of the information we have on the outside bar that's on the 15 minute right here. So here's our outside bar. As you might be beginning to gather for continuation, it is more important, in my opinion, to be able to recognize on a smaller time frame the beginning formation of an outside bar on a larger time frame. So kind of seeing that we're opening it up here before even seeing it here, and then kind of double confirming it with this right here. So again, not knocking it, but it is good to definitely go switch to this as well. We're clearly in a downtrend. We see an initial high made, we wait. So we see we're pushing up. We know that we're in a downtrend. We see a high get made. When the higher high is made and fails, so you see the higher high push up right here and then fail, we enter our short and target the lower low. So he's entering here, keeping his short, or you could keep your stop loss at that high and that high there. And he's targeting this low, he's targeting this low, he's targeting whatever level he might have outside of that. Very cool example. And this is definitely one of the strongest candlesticks. I like this a lot because just like for the same reason Leeland said, it's not just for swing trades. It's for so much more. It's for information gathering. It's for, you can see how aggressive the market might be being. You can take day trade scalps on it. You could even just take some mental reps on it. But the method to reversal. Unlike the continuation method, with the reversal method, we are looking to take advantage of the outside bar after it has formed, with expectations of a trend reversal. We never want to enter on the fresh new low. We always wait for a retest. You can see very, very good, clear examples here. Did a really good job getting these. In the example below, we have a very strong outside bar highlighted on the daily time frame. It is also a bearish engulfing, giving us added confirmation that we are possibly seeing a reversal type outside bar, because it's not just a bearish candle, it's rejecting a good bearish area of the chart. Remember, we don't want to enter on a fresh new low made by the outside bar, so we don't want to enter this. We always want to wait for the retest, and you can see why. It took 5 days of retesting and rejecting the 50% and golden pocket retracement levels before confirming the reversal. So, I mean, it took 1, 2, 3, 4, 5 before it even made a new low. So if you would enter this, theta alone would have had you screwed in your swing trade. So it's very good to at least wait for that confirmation. And you can see here, another more zoomed in confirmation. You can see after they made the new high, or I'm sorry, they hit the high, they pop, they hold the high, bring it back down. Good rejection of the fib, of the drawdown move, of this outside bar. They reject that fib. And you can see multiple areas where they pulled back, they struggled again, even with closing here, open lower the next day, another rejection end of day that day, another drawdown. So just very, very clear breakdowns. Just like the previous example, the bearish example, this strong outside bar is also a bullish hammer, giving us a strong confirmation that this is a reversal type outside bar. Remember, we wait for the retest. In this case, the following day perfectly held the outside bar hammer's 50% midpoint and closed above the high. The next candle is an inside bar, which we already broke down this example on page 23, so we don't need to do it again. So again, just kind of seeing, again, that example of seeing that combined patterns, combined effort. You know, it's not just one candlestick or one candlestick at a good spot. Sometimes it's multiple candlesticks at multiple good spots, and it's giving you stacked on confidence. Method 3, the potential outside bar. This is possibly the most advanced pattern to trade in this entire handbook, but also the most rewarding in my opinion, and you'll see why. This is where a lot of Leeland's biggest percentages come from. Everybody's always excited when he posts those, but he doesn't get them all the time, and that's because these don't happen all the time, and they're very hard to go after, and you'll see why here in a second. It is similar in practice to method 1, in that we are trying to trade the formation of the outside bar, but we're doing this on a larger scale, mostly commonly the daily time frame, and it involves an added factor, the previous day 50% control point, the midpoint, which a lot of you guys love adding that. It's not hard to add at all. Above are both the bullish and the bearish examples of how you trade this potential outside bar on the intraday time frames, taking advantage of the previous candle high, low, and midpoint as entry and exit opportunities. Entry 1, bearish. Price is traded above the previous day high, but fails to hold plus retest and rejects. Entry 2, bearish. After trading above the previous day high and failing, which is required, again, if you don't fail under this, if we don't get that break under the previous day high, the good rejection, and then a break of that day's 50% control point. So again, just looking for good pressure to get above, to lose some steam, to get a rejection, a retest under the previous day high to move down, and a retest under the previous day's 50%. Those are just two areas you're looking for, and that's it. And if it can make it to the previous day low, and this is going to be the makings of an outside bar in real time. You'll be seeing an outside bar making in real time. You just, again, won't see it till afterwards. Entry 1 for the bulls. So here, so we dropped under the previous day low, rejected, failed to make a new low, pushed back above. So we're, becoming a little bit more promising. Working back down, we got the retest finally. We're back above previous day low. We're in, right? So this is kind of first entry. They worked to the previous day's 50%. Big fancy way of saying the middle point. They end up working back above it and giving us a retest here. Now, guys, remember, at any time you see us talk about retest, we're not just talking about price perfectly holding that level. Remember the 3 types of retests. I've gone over them many times in stream, many times in Discord, many times in my video. If you haven't, one of my latest videos is literally me going over the 3 types of retests. So if you need more, examples on that, breakdowns on that, please refer to that. But that is what you're going to be using. The single candle retest, the midterm retest, the full term retest. That is what we're looking for in these circled areas as they're retaking good areas. And then, of course, like I said, the second entry, getting back above that control point. Price now fails to hold below and rejects the 50% control point. Oh, sorry, this is a lot. Let me get another sip of water before we finish this off. The outside bar continued. To the left is the daily time frame. This is the time frame that the outside bar is potentially forming on. Below is an intraday time frame, the 5-minute, that we would be executing the potential outside bar trade on. So we're using this to help us trade here. You can see I've circled 3 entry opportunities. First is the failure to hold below previous day low after price is traded below the level. This is required to actually create the outside bar. Remember, outside bar equals a lower low and a higher high, so we need that low to be made, even if it doesn't hold the rest of the day. Second is a break above in a retest of the previous day midpoint before rallying to the previous day high and higher. Third is another retest and hold of the previous day midpoint with the hammer before rallying to more new highs. So not just holding the previous day low, not just the first time they held the previous day low, but also the second. Seeing that second time show up is really confident too, because it really shows, okay, buyers are really trying to show that they are present here and want control of that area. And then kind of the same thing, but to the opposite side, seeing the outside bar to the downside. To the left is the daily time frame. This is the time frame that the outside bar is potentially forming on. Below is an intraday time frame, the 5-minute that we would be executing the potential outside bar trade on. So again, using this to help us here, just keeping it simple with the levels here and trading here. First is a failure to hold above previous day high. We see that here, or right here, sorry. We opened higher, dropped down under. After price is traded above it. This is required to actually create the outside bar. Remember, outside bar equals lower low and a higher high. So we have to have this for us to later have that representation of, oh, this is an outside bar. We don't get this if we didn't at least push above it a little bit, right? Second is a break below and retest of the previous day midpoint before dumping to previous day low and lower. So we see that rejection here, working to the midpoint, another rejection, and then making it to the low, and not just hitting it, but making that new low. And this is where those exponential gains can possibly come from when you use these retests correctly against these good areas. So when you get an outside bar or potential outside bar, we get that higher open, you want to look for rejections of previous day high and the halfway point of that previous day. You'll notice in both of these examples, I have a dotted horizontal line above the previous day high in the bullish example, below the previous day low in the bearish. This is a negative 50% Fibonacci extension. Adding the extension to your Fibonacci tool settings will project an extension of exactly half of the distance between the previous day high and previous day low. So it's taking half of this range, and it's moving invisible targets out further of your range. So if you ever are trading outside of that range, you do have targets even if you don't have levels there. Excuse me. And you guys have seen us go over this a lot in the streams. It is incredibly powerful and accurate. Price is constantly making measured moves using previous candles' magnitude. I love this. I love how he wrote that. So conclusion, we're finally coming into this. Wow, I kind of felt like we had more. This is such a powerful reading. Seriously, I'm really happy I got to read through this with everybody. But conclusion, there are many more candlestick patterns out there that are not covered in this handbook. For example, in addition to the 1 white soldier and 1 black crow, there are actually a 3 white soldiers and a 3 black crow continuation pattern. The handbook provides a detailed overview of, in my opinion, the strongest candlestick patterns, their significance, and how to interpret them effectively. And you can quiz yourself. He even added a really cool end page here that goes over basically everything. You can just quiz yourself, go back through it. You don't even have to worry about the names not being here because you can just go through them now. So pretty cool of him to do that as well. So you can cut these up if you print this out or whatever you want to do. But guys, thank you again for being here. If you guys have any questions, feel free to drop a comment below on this. This is recorded. This is being saved for everybody in the Lifetime group. And yeah, I'm just really happy to have this set up for everybody. This is a really cool handbook. I've personally gone through this 3 different times. After it was released, I went through it a couple times while it was being made, and just got to kind of watch it, while it was being made. It was just really cool. I got to see the whole journey for everything that Leeland made here. And this is really everything I've ever done in my swing trades and a lot of my day trades and the way I think, except he really put this in the most organized manner ever. Like I would have never have done this. This is amazing. And you could say the courses are great and stuff, the swing trading breakdowns, you could say he got stuff from that, but it took him a lot to do this. He had to find examples on his own, and Leeland really has fallen in love with the craft. I would say these outside bars really took a grip on him when it came down to the the intricate trading, the breakdowns, kind of having methods, having parameters, a set. I think that's what really hooked him, was that it had rules. It had set rules. There wasn't a bias of like, well, I thought this, no, there's no thinking involved. It either did that or it didn't do that. You're either right or you're wrong. And I think that's why he likes it a lot, because it's very decisive. It's very cold. It makes sense off the rip. There's no, fake out that is lying to you. If it faked you out, it's because it did go back up. It is going higher. It is bullish. There's no doubt about it. So you don't have to sit there and worry about it. Don't sit there and, meddle in your feelings or think about stuff like that, or make it seem like it's a mental thing. Candlestick patterns are the closest we're ever going to be to trading like a computer. And I really do thank Leeland for putting this together, because I think this is going to be something that really helps a lot of you and makes you more of a powerful trader. And if not, then definitely a more confident trader that is at least able to be aware of what's in front of them, or at least able of the visual cues that are going to be popping up every day or every, smaller time frame, or whatever time frame you're looking at. But I really do appreciate Leeland for putting this together. Shout out to him. Love that man. Love that guy. Seriously. Really cool breakdown here, and I hope you guys like it too. I hope you guys go through this many times. Please don't feel like you only have to go over this once and that's it. Go through this, and don't just do this. Go to your TOS, go to your chart, put on a 9 EMA, put on a 21 EMA, and just leave those two on, and just look for candlestick patterns. Look for, oh, we have a good resistance here. Let's see if we can close above it. Awesome, we did. So again, kind of like he said in that video, or in the handbook, not taking the new high, waiting to see a retest. And then on the smaller time frames, we can zoom on down to this and we can see, oh, this day we could have bought off the dip and tried to take it back up, or on this day we could have waited knowing that this day held. We could be looking for calls on this day, and if it didn't work out, waiting again, and just kind of going off of basic stuff like that, and it's really cool how just basic planning can lead to some of the most powerful decisions that you make, some of the most powerful trades that you end up taking. So I hope you guys enjoy this. I'm going to go edit this now and put it up on the channel. I was going to do a live stream of this, but then I thought, you know what, knowing me, I'll start rambling too much if I'm answering questions live. So I wanted to record this beforehand. I'm going to be posting this as soon as possible, but it'll be up before you guys are even up, so it doesn't matter. But either way, thank you guys for paying attention to this. If you have questions about anything or any comments or anything you just want to add, it's not just questions. If anything you want to add on to anything that might have been posted in here or talked about, please put it in the comment section. I'd love to reply. Leeland will reply as well. We can both see this. So yeah, but thank you guys again, and I will see you on the next one.